Is the calm world of municipal bonds about to get rocked? The Wall Street Journal says trouble is brewing. We're going to examine that and much more, so stick around. Broadcasting to you live from the Ski Chalet here at ETFguide Studios. I'm Ron and DeLegge, and it's great to see you again. Be sure to subscribe to our channel, and don't forget to check out my online classes, as well as the portfolio report card, where I analyze and grade your investments. I've got links posted in the description section below this video. Municipal bonds are today's topic, and as we head into 2021, we're all going to be exactly 1 year older, and that's nothing to be ashamed of. There's no regret in getting older because it's a privilege denied to many, and with each passing year, when you think about it, we become more and more of ourselves, which you certainly can't do when you're 15 years old. So make it your aim to become a better version of yourself compared to last year's model. So in this episode, I want to do three things. I'm going to share with you this recent Wall Street Journal piece about municipal bonds. I'm going to give you an update about the performance of muni bond ETFs, and then I want to explain to you why municipal bonds are not as tax efficient or tax friendly as you may think. So let's get right into it and begin with this Wall Street Journal article, which appeared in the December 25th issue. And a couple of highlights, Mario Cuomo, New York governor, in a March radio interview saying, "We have no money." Pretty scary at the time. Well, they do have money. They just have a lot less than they had before because, as this article observes, state collections are down about 6.5% nationwide. And that's on expected growth of 2 to 3%. That didn't happen. So the coronavirus shock is real. It's affecting states and local governments all over the place. And so how do municipal bonds, or where did they get most of their income? Well, they don't rely directly upon the general taxing authority of state or local governments. And this article points out that two-thirds are revenue bonds backed by some other stream of income. And investors should take little solace in the fact that downgrades have been muted so far. Well, one of the things I want to say about that, these credit rating agencies are often the last ones to notify you of a credit downgrade because they themselves are a lagging indicator. We saw this in 2008 financial crisis, and future crises will be the same, where credit rating agencies will completely miss the ball, and that's why the ratings on municipal bonds, and all bonds for that matter, are a lagging indicator. Municipal bonds backed by airports, hospitals, toll roads, universities, nursing homes, or stadiums could be in particular trouble. Normally, these are desirable issuers because they're paid with their assets revenue from special taxes, even though a city or state's bankruptcy might not affect them. Next, and this is the final portion that I want to highlight of this article, that the pandemic's initial effect on the muni market might be scattered defaults in categories obviously strained by initial effect, such as hospitals, but states' cash flow problems today could hasten the market's real doomsday scenario, a state being forced to choose between short-changing bondholders or retirees. So this is something definitely that merits monitoring. And of course, one of the advantages of investing in municipal bond funds and ETFs is you get diversified exposure as opposed to owning concentrated positions to individual municipal bonds. So let's examine now the performance of the iShares National Muni Bond ETF, ticker symbol MUB, which tracks a basket of bonds from across the nation. I'm going to share with you what some of those states are in a second. But this chart just shows you the sleepy type of performance that the muni bond has had over the past year, despite all of this chaos that's been happening with states and local municipalities. it's been very calm and quiet in terms of the performance. MUB versus BND. BND tracks the broader U.S. bond market, so there's no overlap between MUB and BND because BND excludes municipal bonds by exclusively holding investment-grade corporate and U.S. government debt. So that's an important detail. My next chart is a token look at TQQQ. I mean, we compare it to everything else. Why not to bond ETFs? Some of you watch this channel for no other reason, by the way, than to get their TQQQ fix. And it's pretty clear that I've become a sucker for your delusions and a participant. So I hope you're happy. And you can see here that as the emojis show you, puke levels in March of 2020, from that to exuberance at the end of 2020. TQQQ has been a great performer, and it's blown away, even with all that volatility, these ho-hum, sleepy performance of bond ETFs. But nevertheless, that's not a one-to-one or apples-to-apples comparison, so just FYI. So the next chart shows you MUB's muni bond exposure. Well, actually, this shows you the yield, this particular chart. You can see there the SEC yield for MUB just under 1%, and that's not a lot. Now, if any of you own municipal bonds or bond funds with a yield that's more than that, it's not necessarily because your bonds are better or your bond fund is better. It's due to the fact that your bonds have higher credit risk or have longer durations, or your fund manager is using leverage to juice the fund's yield. So just FYI, you got to be aware of what's going on behind the scenes. This next chart shows you the breakdown of the bond exposure in MUB on a state-to-state basis. You'll see around 50% of the holdings have exposure to municipal bonds for just 3 places: California, New York, and Texas. Now, I want to talk about correct asset positioning and connect the dots for you on this, because correct asset positioning is so crucial to your long-term success. I know, again, a lot of the focus is mostly on the investment positioning, but correct asset positioning happens when you deliberately and systematically place your accumulated assets into the containers that produce the absolute lowest tax. And that should be the goal. Now, people, again, tend to focus too much time on investment positioning. I'm even guilty of this, but we cannot ignore the crucial role of asset positioning. Both are important to your long-term success. And I've seen many, many portfolio report cards that I've done where there's wonderful investment positioning, but it's being undermined by poor asset positioning. So we don't want to see that. I don't want to see that. So correct asset positioning really has 2 facets. The first facet is that the asset must be located in the right bucket. And then the second facet is it must be in the right dollar amount in that bucket. So you see each of these 3 buckets you're looking at have a mathematically ideal balance. And in this case, municipal bonds, whether they be individual bonds or bond funds or bond ETFs, if you decide to own them, they belong in your taxable bucket. That's the correct location because that's where you're going to receive the greatest tax benefit. But I want to drive home the second facet of that point, and this is that the dollar amount or size of those investments in each bucket can either positively or negatively impact your asset positioning from a tax perspective. And I'm going to show you this example of a investor that has $1 million invested in municipal bonds. Okay, that's in their taxable bucket, and they've got another $1 million in their tax-deferred bucket, in their IRAs and 401ks. Now, at first glance, when you see this, you may say, well, I don't see anything wrong. These folks seem to be in pretty good shape. They've put their municipal bonds in the correct location, which is true. But it's the size of that investment in the taxable bucket that triggers the hidden problem. And that's what we're going to show you right now. This next slide illustrates the hazard of John and Jane Doe. They've got a $2 million portfolio, and at first glance, well, everything seems great. Municipal bonds generate $10,000 a year. The required minimum distributions from their IRAs and 401k plan generate about $36,000 a year. Now, that's just in year one. Remember, RMDs grow each and every subsequent year, which means the taxes grow. So that's why we want to really watch that bucket also and make sure the size on that one is correct. And then the final piece of the pie is the Social Security income. They're getting $40,000 a year. Now, keep in mind, half of that amount counts as something called provisional income. So to review provisional income, this is the number that the IRS keeps track of to determine how much of your Social Security income gets taxed. And from a retirement planning standpoint, we don't want any Social Security to ever be taxed, because if it disrupts the rest of the portfolio by forcing you to sell assets that you probably want to keep to pay taxes. And in a down market, you're at a major disadvantage, because now you're selling holdings that are falling in price, and you're selling to pay taxes on your Social Security income. And as the taxes grow, guess what? So do your tax burdens. And before you know it, this wonderful portfolio that took you several decades to amass is now being depleted, putting you at risk of running out of money. It's one thing to run out of money when you're 35 and you're still working and you're employable. It's a completely other thing to run out of money when you're 75 and you're not. And nobody in their right mind wants to be squeezed back into the workforce at 75 because they depleted their retirement savings but due to poor asset positioning. And by the way, this is a sort of major league problem that the portfolio report card catches while it's still a minor league problem. So again, one of the huge benefits of having a portfolio report card done each and every year. So the question then is, what counts as provisional income? And then what are the provisional income thresholds that you need to stay under to ensure that your Social Security income comes back at you tax-free? So let's answer the first question. What counts as provisional income? Well, it's your adjusted gross income. So that can include pensions, it can include wages if you're working part-time into retirement. It includes interest, ordinary dividends, as well as capital gains distributions. And this all adds up very quickly, as you probably already have figured. Also, 1/2 of your Social Security benefit counts as provisional income. And then any tax-exempt interest from investments like municipal bonds, which is what we're talking about today. So while the income may be free from federal taxes, and in certain circumstances state taxes also, it's not free from taxes on Social Security income. And in this example, you can see John and Jane Doe have $66,000 of provisional income, which is way above that $44,000 threshold, which exposes 85% of their Social Security income to tax. And as we see, that $1 million municipal bond portfolio is contributing to the problem because of that income. Although it's, again, free from federal and state taxes, it still counts as provisional income. How much better it would have been for John and Jane Doe had they done a little bit better planning and correctly positioned their assets so as to reduce their overall tax liabilities to the greatest degree possible. So simply owning municipal bonds in itself does not necessarily mean or make your investment portfolio tax friendly or tax efficient, nor does it indicate that you've got correct asset positioning. And if you're in this situation where you own a lot of municipal bonds and you think that you might have a similar issue or problem or hazard as this example, go to portfolioreportcard.com and get in touch with me. The first step is to diagnose the problem and to see if a problem even exists. And then after we've done that, then you can go to step 2 and figure out what needs to be fixed. But we always start with the diagnosis. It's a very therapeutic approach, which is quite different and opposite to the mainstream financial services industry, which likes to give recommendations, and you should do this and buy that and do this and that, and give you prescriptions even before seeing the patient. So we never do that. We always want to identify the problem, diagnose it, and then from there, you want to eliminate those flaws, those structural weaknesses inside your portfolio, and then build on the strengths. And the goal, of course, is to always have a well-built, architecturally sound investment portfolio that gets a grade A every single year. So, what are the key takeaways from today's discussion? Well, first of all, municipal bonds are best held in your taxable bucket. That's where you're going to receive the greatest benefit. Municipal bonds, as we know, are still subject to capital gains tax. They don't escape that, even though they are free from federal taxes and in some cases state taxes. Municipal bonds add to your provisional income and could cause your Social Security to be taxed. And so that's an important thing that often gets overlooked and forgotten. And the bottom line is, listen, nothing wrong with municipal bonds if you own them in the right place and in the right quantity, but owning them in the wrong dollar amount, and our example highlighted that, undermines your asset positioning from a tax perspective. And so I hope you've enjoyed today's episode. And if you have, be sure to like this video. And that concludes today's chat about municipal bonds. I'm Ron DeLegge with ETF Guide. Thanks for watching.